Imagine two people, both graduate at age 22. One starts working in 1985. The other is 2026. Both receive similar advice. Buy a house as soon as possible. Stay loyal to one company. Keep all your money in the bank. Debt is always bad. Investing is risky. The first person follows that advice and retires comfortably. The second person follows exactly the same advice and struggles financially. What changed? Was the advice wrong? Not necessarily. The world changed. Interest rates changed. Housing prices changed. Technology changed. Careers changed. Investing changed. Today, we're going to explore several financial beliefs that worked for many previous generations, but may quietly hold people back today. Not to criticize the past, but to understand why every generation needs a different financial playbook, because good advice can become outdated. Mistake 1. Believing one job was enough. Imagine graduating in 1985. You join a large company. You work there 35 years. Steady promotions, reliable pension, predictable raises. For many people, that strategy worked. Now imagine graduating in 2026. Entire industries change within 5 years. Artificial intelligence reshapes jobs. Companies restructure constantly. Skills become outdated much faster. Today, job security often comes less from loyalty and more from adaptability. The valuable asset isn't your employer, it's your ability to learn. The modern economy rewards people who continuously develop new skills, not just people who stay in one place. Mistake 2. Thinking a house is always the best investment for decades. Buying a home was considered almost automatic, and historically, in many countries, it worked extremely well. Let's imagine buying a house in 1995. Price, $150,000. 30 years later, that same home may be worth several times more. Now imagine buying a similar property today. In many cities, home prices have risen much faster than incomes. Interest rates are higher. Insurance costs are higher. Property taxes are higher. Owning a home can still be a great decision. But today, it isn't automatically the best financial decision. Sometimes investing first and buying later produces better long-term outcomes. The lesson isn't never buy a house. The lesson is run the numbers. Mistake 3. Keeping too much money in cash. Previous generations often viewed the bank account as the safest place for money, and emotionally, it still feels safe. But imagine inflation averages, 3% per year. If your savings account earns only 1%, you're quietly losing purchasing power every year. Let's imagine $100,000 sits in cash for 20 years. The balance may still show $100,000, but what that money can actually buy has dramatically decreased. Cash protects liquidity. Investments protect purchasing power. Those are two different jobs. Mistake 4. Avoiding the stock market. Many parents still tell their children the stock market is gambling, and that belief usually comes from painful experiences. Market crashes, recessions, financial crises. But let's zoom out. Historically, broad diversified stock markets have averaged roughly 8 to 10% annual returns over very long periods. Not every year. Some years are terrible, some are extraordinary, but time smooths volatility. Risk doesn't disappear, but it changes. For long-term investors, not investing can sometimes become a bigger risk than investing. Mistake 5. Lifestyle inflation. Imagine receiving a raise. Your income doubles. Wonderful. Now imagine your spending doubles too. Larger home, luxury SUV, premium subscriptions, designer furniture. Everything looks successful, but wealth hasn't grown. Only expenses have. Many previous generations measured success through visible ownership. Today's wealth builders increasingly measure success through invisible assets. Investment portfolios, cash flow, financial freedom. One creates appearances, the other creates options. Mistake 6. Depending only on a pension. For many workers decades ago, employer pensions were common. Today, many companies no longer provide guaranteed retirement income. That means retirement planning has changed. Instead of relying on employers, people increasingly build retirement themselves. 401k index funds, ETFs, retirement accounts, automatic investing. The responsibility shifted. Understanding this early changes everything. Mistake 7. Waiting too long to invest. Many people were taught, I'll invest when I earn more. Let's compare two investors. Investor A starts
25,
at, Investor B starts at
35.
Both invest. $500 every month. Both earn identical returns. By retirement, Investor A often finishes with dramatically more wealth. Not because they invested much more money, because they invested more time. Time often matters more than amount. Compounding rewards early action, the biggest difference between generations. Previous generations often built wealth through stable careers, property appreciation, employer pensions. Today's generation often builds wealth through knowledge, automation, global investing, digital businesses, multiple income streams, continuous learning. Neither generation is smarter. They're simply solving different problems. Every generation inherits a different economy, which means every generation needs different financial strategies. Here's what this video isn't saying. Your parents were not wrong. Your grandparents were not wrong. They gave advice that worked remarkably well for the world they lived in. But financial advice has an expiration date, just like technology, medicine, or business. The people who succeed financially usually aren't the ones who blindly follow old advice. They're the ones who understand why the advice worked, and whether those conditions still exist today. If there's one thing I'd like you to remember from this video, it's this. Every generation believes its financial advice is timeless. History suggests otherwise. The goal isn't to reject the wisdom of the past. It's to update it. Learn from previous generations. Understand the world they inherited. Then build a strategy for the world you actually live in. Because wealth has never belonged to the people who refused to change. It has always belonged to the people who adapted. I'm Morgan Vals. Build small, grow strong, live free. And I'll see you in the next video.